Bollinger Bands are a popular approach with some traders, and I think it can add an extra dimension when it comes to looking at markets. So in this video, I'll go through how they're made up, how to use them on markets, and the pros and the cons of this particular approach. In our regular market videos, we often look at the RSI, an overbought, oversold indicator, the MACD as well now and again, but I thought, well, let's do a session on Bollinger Bands. So this is Euro US dollar with the bands on them. I'm going to talk in this video a bit more about what these bands show, how we can use them to try and help our trading. But you can see here it's made up of three parts. We have the line in the middle and we have the bands either side, and they can help us try and figure out which way the market's going. Has it become overextended? Is it about to go quiet? Are things about to experience an explosive move? So I'll talk a bit more about this in this video, then we'll jump back and look at things in more detail.
Hello, my name's David Jones from Capital.com. And this time around, I thought we'd do something different, looking at a trading tactic. And as you saw there, the one we're going to look at is the idea of Bollinger Bands. So in this video, as usual, I'll go through the construction, the theory behind them, then we'll jump backwards and forwards onto the platform to see this in the real world, in real markets, and to see how it could help our trading. I think it does help give perhaps a different dimension to your analysis when you're looking at markets. As usual, if you're watching this, if you could click on subscribe, it does help support the channel, and it means we can continue to push out 4 different videos every week on the various topics we cover. So let's get into things. Let's start things off and look at Bollinger Bands in more detail. So the name doesn't come from the brand of champagne you can buy after they've signaled lots of profitable trading signals, but they were developed by a man called John Bollinger, and they've been a popular approach in financial markets in technical analysis for many years. If we start off with the middle line from the Bollinger Band indicator, this is just a simple 20-day moving average. If you're familiar with moving averages, you know what this is. So the 20-day moving average today is the last 20 days, typically closing prices added up divided by 20. So an average price for the last 20 days, and then bang, the next day, it plots the next one. But of course, around this, we have the Bollinger Bands. So it's like an envelope around this 20-day moving average. Bollinger Bands are placed 2 standard deviations away from the moving average. This way, in theory, it should capture 95% of the price data. So 95% of the price should stay contained within these Bollinger Bands that are 2 standard deviations away from that 20-day moving average. So there are a couple of ways of using Bollinger Bands. They can be used to spot when a price has become overextended, so has had a significant move, an increase in volatility. And also on that volatility aspect, Bollinger Bands can also be used to try and figure out when volatility might collapse in the market, or also in times of a period of low volatility when we can expect potentially a sharp move in the market, so a sudden jolt in volatility. Let's take a look at the bands in more detail on a chart, then we'll come back and talk more about a trading approach.
So this is Euro US dollar. Let's just walk through what I've just talked about. So here in the middle, we have 20-day moving average. So you can see this is the line here. So it's just an average price of the last 20 days. And of course, typically when the price crosses above a moving average, many would see that as a buy signal. When the price falls below a moving average, like back here, people would see that as a sell signal. But what's the next step for our Bollinger Bands are the actual bands themselves. So these are the bands placed 2 standard deviations away. And you can see in times of low volatility, we have fairly tight bands. So when the market's going sideways, not really moving, the bands tighten up. Then when we have these big moves like here, you can see the difference in the size of the band. So when the market moves to an extreme on the band, it can be a suggestion that perhaps the market's overextended. So the current move is overextended. And when we have the bands tightening here, it can suggest that perhaps we're going to see volatility increase. We're going to get something of a breakout, and it's what we had there. So there are a couple of ways of using these. I'm going to talk about them more, then we'll come back and look at some real trading examples.
So you can see there from the examples we look at that the bands will expand, move further away from that moving average, and contract, move closer in to the moving average, depending on what's going on with price volatility in that market. So it's being led by what's happening with the price. In periods of high volatility, when the market is really moving one way or another, the bands move further apart. And then as volatility drops, as the price swings become smaller, we see the bands narrow and contract and move closer to that 20-day moving average. When the bands are really close, signifying volatility is really very low, some traders will be expecting a breakout because volatility tends to not remain low for too long. So they'll be expecting a breakout. We just don't know in which direction, but we are expecting a much more explosive move than we've seen in the markets during this period of low volatility. When the bands are extreme, when they're wide apart, it's normally showing a trend, but it can also suggest at these extremes that actually how much longer can the trend carry on at the current pace? It can be a sign of a market running out of steam. Let's take a look on the charts and look at some real examples of trading opportunities.
So let's take a look at the last few months of euro US dollar. So what we're looking at here, if the price moves up towards the upper extreme, we're expecting the price to revert back. We're saying it's got overextended. And actually, this worked pretty well. If we pointed out during August, the market moves to an extreme, actually pokes through. And let's not forget, the Bollinger Band is designed to capture 95% of the price movement. So it's suggesting that perhaps this is an extreme. So playing the range on the Bollinger Bands during August would have worked well. So we're looking to sell when it moves to the top extreme and looking to buy when it moves to the lower extreme. But of course, it doesn't work all the time. And here we have the market actually starts breaking lower for a week in September. So that's playing the range of the bands. Then we have the periods where the bands contract. So if we go back to June, we can see from June through to July, we had fairly tight Bollinger Bands, suggesting that volatility is low, but it's probably not going to last forever. And then the price starts to break out. And you can see here, if you were playing the extreme for Bollinger Bands, so selling because it came to the top of the band, it had been a losing trade because the market did actually carry on trending all the way through July. And we had a big run in the euro of about 500 points into the end of July, early August. So in a second, I'll talk about how it's important not to have a fixed approach all the time. We still need to think about risk management. Let's take a look at another market. So here's the price of gold. I think a market plenty of us will be familiar with. And we can see from sort of May through to mid-June, we had fairly tight Bollinger Bands, but they started moving apart. So again, those tight bands suggesting we're in a period of maybe somewhat slightly exceptional volatility. Perhaps we're expecting a bigger move here, and the bigger move is what we've got. At the moment, looking at the price of gold, we can see the bands have narrowed again. We're back on Bollinger Bands to where we were pretty much in September, for the first couple of weeks of September for the Bollingers on gold. So we're getting the bands narrowing. So again, suggesting volatility is quite a bit lower than it has been more recently in gold. So we should be expecting a move. The only question is we don't know which way the move's going to go. The Bollinger Bands are not saying it's going to move up or down, but it is a suggestion that perhaps we're going to see an explosion in volatility after a period of relatively low volatility. So it makes it an interesting market, I think, to watch after what's been a fairly quiet time in gold. So when the bands reach an extreme, it can be a suggestion that the trend is running out of steam, but that clearly wasn't the case in gold during July. If you'd have just been selling blindly into this rally because we were at the extreme of the Bollinger Band and actually breaking out through it, you'd have been the wrong side of the market. So I would use them as a guide rather than a hard and fast rule for going against the trend. Perhaps we would have wanted to wait till at least here, late July, where we saw the market go sideways rather than just making new highs for the move every day. That would still have been a wrong decision. Don't get me wrong. But again, if we'd done the same thing again in August, finally we'd have captured the move where the market reverts more back to the middle, back to that moving average. So I think we can use them to go against the trend, but wait for some additional confirmation.
Of course, as I often say when we look at different indicators and different techniques, there is no magic system. There's no system that's right all the time. So it's really important to still have risk control. Don't sit there and blindly follow Bollinger Bands and think they're going to never deliver a losing trade. So we still need to think about techniques such as stop losses when we're trading using Bollinger Bands. One obvious place, I think, to have a stop loss, if we're placing or expecting a reversal off the Bollinger Band, by definition, if it doesn't start reversing, we should think about getting out. So if the market's moved to an extreme and we're buying or selling, then have a stop loss at least a few points beyond that extreme. So if the market carries on in this overextension, you're out of the trade with a manageable loss. Let's take a look at what I mean.
I talk a lot about risk management in the various videos that we do. So let's take an example at the moment, looking at gold. Gold is trading at about 1886 at the moment. We're moving to the bottom of the Bollinger Band. So let's say we need to bear in mind that we do have fairly tight bands at the moment. So volatility has been low. But if we were going to play the reversion here, looking for the market to move back into the middle from the Bollinger Band, we still need to think about stop losses. So I think there's a couple of approaches here. We either have our stop the other side somewhere of the Bollinger Band. The Bollinger Band is currently sitting around 1878, that sort of level, or revert more to more traditional charting support and resistance methods and have it below a recent significant low. Let's go back to these mid-October lows around 1872. So the point to make is, whilst Bollinger Bands can be useful and give us this added dimension, don't just follow them blindly. Have a definite risk management stop loss in place. The same way if back here in the third week of October, we'd have sold as it tested the above Bollinger Band and that worked well, have a stop loss above perhaps that more recent high from the 11th of October. The last example we look at, the S&P 500, this is again the daily chart, and we can see the S&P is pushing through its lower Bollinger Band. So even as I'm recording this video, we're seeing a break through that lower Bollinger Band. So we could take this as the market being overextended, but let's bear in mind what that trend is. That trend is still down. And we have seen over the past month or so, a couple of occasions where the S&P has had a look through the Bollinger Band, but ultimately it snapped back. So this does make for an interesting setup where we're seeing the S&P perhaps fairly overextended down here, like it was just at the top, just a couple of weeks ago when it pushed through the Bollinger Band and eventually reversed. But I think, again, the more disciplined approach here is to at least wait for the market to stop falling. If we don't just jump in because it's breaking below that lower Bollinger Band, wait for a bit of price stability. So perhaps we couple this with an hourly chart and we want to see at least the market on the hourly chart form a base rather than just jumping in blindly. But I think it makes for an interesting setup at the moment. So it does look like the market's overextended. I'd be quite tempted to be a buyer at some point down here, but I want to see a reversal in the shorter term time frame. And I still probably want to have a stop loss. I'd probably have it the other side of these end of September lows. So it's an interesting setup happening in the S&P, looking for this market to revert back after a pretty steep sell-off over the last few days, but waiting for some additional confirmation. But that's one way the Bollinger Bands add an extra dimension to all of this when it comes to markets.
That's it for the update on Bollinger Bands. I do think, as you can hopefully see, they can add a different dimension to the normal sort of trend, support, resistance, overbought, oversold approach that many people use. But from me, David Jones and Capital.com, we'll leave things there. Good luck with your trading.
For more trading videos just like this, please subscribe to our channel.